All right, we are live. Yes, we are. Tech is up, tech is working. Shake it out. Let's get ready for this live stream. And here we go. Welcome back, investors, to Ticker Time News. I am Adam, and the market today, it was choppy, like normal. We also got some interesting news from FedEx in the after hours. They reported their earnings, missed on EPS and revenue, but their guidance was pretty interesting. And we got an upgrade on WeWork, which is an interesting company. We'll talk about that. Coinbase, we mentioned this yesterday in the after hours, and we were looking at the stock chart saying, oh, this news isn't moving the stock. Well, the stock moved today off of that news. So we'll dig into that just a little bit further and talk about Coinbase, Coinbase Pro being sunsetted and moved over to the Coinbase main product, main app. All right, so here's the deal. I'm going to give you the quick take on the market at the beginning. At the end, you have questions, leave the ticker symbol and your question in the comments. We'll go over it live during the show. Your questions are the most important part of this show, and it's the whole reason why I do it to begin with. And also, if the quick take can help you along your investor journey, then that is mission accomplished. And I am very happy for that. All right, here we go. The market today, it was another choppy day, right, of trading. But the crux of the problem, like yesterday, I talked about yesterday was a win for the bulls. Well, today was a win for the bulls too. However, we have to be aware of the bubbly stuff that's right underneath the pass, or the bubbly stuff that keeps popping a little higher for the bridge that we're walking over. Whatever metaphor you want to use to explain the situation we're walking into, okay? Growth concerns are a big one. And those concerns were evident in the market today, all over the place. The underperformance of the cyclical energy. Let me pull up the 11 sectors of the S&P 500. And if you want a link to this group to chart it out yourself, you can. Look at energy. Energy is down here at the bottom. It was down 3.7% today. Energy was also down yesterday too. Energy is on a big pullback right now. And actually, I want to measure this. I want to know for sure how far energy has fallen since peaking. So if we go to the top of this box right here, and we measure down to the bottom, and I'm going wick to wick on this one. So the full scale of this, the energy sector in the S&P 500. Now, energy is not a big weighted sector like information technology. That has a heavy weight in the S&P 500. Energy, not so much. However, during this whole rise of energy in 2022, there are some companies that have become mega cap companies due to this rise in energy. I'm looking at you, Chevron. I'm looking at you, CocoaPhillips. I'm looking at you, ExxonMobil. They have been up and up and up and up in 2022. And now we have this 24.7% pullback, almost out of the correction territory and into a bear market. Because remember, my apologies there. 10%, if you're down from your high, 10%, that's a correction, right? And if we were still within this trading channel right here and didn't fall out of that, that would have been a correction down to the bottom of the trading channel, bounce right back. But no, energy fell below that level, even fell below an area of support. So now we got to start looking for other areas of support. I'm going to show you that in just a moment. So that's 10% correction territory. If you're down 20% or more, you're technically in a bear market. That's the technical term of it. Now, I know energy isn't all of a sudden going from hot to not in the matter of a few trading sessions, but it is down 24.7% from its peak. And that peak was hit on June the 8th. And today is June the 23rd. So not even a month ago, right? All right, so that's energy. And let's look for another area of support here. I'm going to clone this bar right here, this green one. And I'm going to clone it. I'm going to bring it down to the next area of support, which should be around here. Okay. And let me stretch it out a little bit further. That's the next area of support. And what I find interesting about this area is the wick of today's candle went down into that box right there. The wick for energy went into that box of support. It found its support and it backed off, right? It rose a little bit higher off of those lows. It's still closed down 3.7%, but at least it did bounce a little bit. So we need to watch this area right here because it is key over the next few trading sessions. And that is right here in this area. We need to watch this. We don't want to see energy fall out of this because energy, there has to be a happy middle. What does Elle say in Stranger Things? Half happy or something like that. We need to be half happy with energy at some point. We can't have super high prices and super low prices. Then we're not getting the technology and the advancement that we have come to expect out of the energy sector. So we got to find a happy medium, half happy. So somewhere sub $100 a barrel, maybe to 90, that area. That seems like a logical place, especially for oil, specifically oil. $100 to $90 a barrel seems like an interesting spot. Maybe a little bit lower than that, maybe to $80 to $90 a barrel. But we don't want to go into the negative like we did during the coronavirus. Okay? So energy come down to another spot. And again, this isn't a place where you want to short energy right now. This is not the place. And this is also not the time to look for long opportunities in energy because it hasn't really found its bottom yet, right? We may have thought that, well, these 3 trading sessions up here, maybe it was finding a base up here. But no. It went further today, further to the downside, to the area of support and came out of that. So that's okay for energy. Now, materials, they were down right here on the right hand of your screen. You can see all 11 sectors. They were down 1.4% today. Financials and industrials were both down 0.5%. Falling oil prices. Let's look at that. US OIL, US oil. That takes you to WTI crude oil. And you can see it's at $104 a barrel, and it's holding still right here. There is a phrase. It is a great one because it is true. Expansion in the market, expansion right here, boom, leads to contraction, contraction, boom. We're looking for contraction in the energy and the oil markets right now for those prices to stabilize. That's what we're looking for. Now, in other commodity prices, grain skyrocketed, grain fell because there was a whole rush and fear of grain all at the same time. Copper was down 5.4% today, and another run of buying interest in the treasury market. And we'll look at the yields in just a moment. But there were other growth concerns areas that were evident in the market today. That was the outperformance of mega cap stocks. They have a very heavy weight in the market, and they can be a leading indicator for how the overall indices may do. And they were afforded some benefit of the doubt that their earnings prospects will hold up better in a tougher economic environment. Now, on the same note, the counter cyclicals, utilities up 2.4%, healthcare up 2.2%, consumer staples also up 2%. Those were the leaders all day, along with the real estate sector up 2%, which drifted off the drop in interest rates. Yeah, interesting, right? So let's look at those. Let's look at the 2-year first. US 0 to Y takes you to the 2-year. Now, the 2-year, it tapped 2.88% this morning after scraping 3.43% on June the 14th. Okay, June the 14th, not that long ago. And here it is, 3.01 is where it's at. That's where it's at. Now the 10-year, let's look at that. US 10Y. And again, you can follow along at home with all of this charting. There's a link in the description of this video to TradingView. Click on it, sign up, free account, doesn't cost a penny, and you can do all this charting as well right along with this. I give you all the ticker symbols that we're using. Okay, the 10-year, it cruised to 3.02% after flirting with 3.5% on June 14th. June 14th was the high for the 2 and the 10 yield. Now, the 2-year and the 10-year both eventually settled the session that looked like a yield inversion was about to occur. Could one be on the way? Are we about to get a second yield inversion in the same year? It's looking like it. Watch this. Let's go to US 10Y, okay? And then in TradingView, you have mathematical equations that you can pop in. Just divide US 0 to Y, which is the 2-year, okay? So we're dividing the 10 and the 2. I press enter and bam. That chart doesn't look impressive, but what I want you to focus your eye on is to the right. This number, 1.026. That's what I want you to look at, that number over there. What does that number mean? 1.026. Well, it means we are literally 2.6 basis points away from getting to another yield curve inversion. 2.6 basis points. And we're at another yield inversion. That just like the one that happened in April. Now, the one in April didn't last very long. It was kind of in and out with its inversion. Maybe this one could be a little longer lasting. However, and the significance of this, it's a precursor to a possible recession down the road. Now, strikingly, the indices came off their lows of the day as treasuries came off their highs of the day into the afternoon trade. That's right. We've been waiting for that kind of divergence there between yields and the market, and we got it today. The late burst of buying interest, just like the opening burst of buying interest, was paced by the mega cap stocks. Let's look at it. The Vanguard Mega Cap Growth ETF, ticker symbol MGK. It was up 1.6% earlier. Saw that gain get paired to 0 and then closed higher, almost higher, the same, 1.59%. We can call it 1.6%. So 1.6% at the beginning of the day, dropped to 0, and then rallied back up to 1.6%. Now that's great. That is really great. That revival, it helped the S&P 500 escape the 3,800 level late in the day. But as was the case earlier in the day, sellers stepped right in just before the closing bell to knock the S&P 500 back below that 3,800 level. We've talked about the 3,800 level as its resistance. And at some point, let's pull up the S&P 500 again. Ticker symbol I use is SPX. Okay, let's look at this. I'm going to put up the 15-minute chart, get off the daily chart here. 15-minute chart. And I want to show you this, okay? Here's today. It is the box in the middle of the screen, all right? Here's where we tagged this top line today at 37.95. So 5 points away from 3,800. We dipped, we bottomed right on the short-term 200-day moving average, not the longer term when you're looking at it from a daily view. And then we rallied all the way back up, all the way up to 3802. We broke above 3,800. But then sellers stepped in and sold, bringing us back down to close at the bottom number, bottom right side of the screen, 37.95. Now, why is this 3,800 level so important? Let's hop over to yesterday. Yesterday's high was 3801, 1 point above it. We go back one day prior and we didn't even get that close. The high was 3779. But if you look at this in a more bullish context, we're making higher highs for the past 3 sessions. It's not by much, but it's something, right? 3779, 3774. Okay, 3774. And then we get to 3801. And then we get to 3802. That's 3 days in a row, higher highs. That's something that you want to see. Now, I'm going to zoom out here a little bit and show you something. Right now, we are in obviously a downtrend. We've been in it all year long. But the important part here that I want to show you is that at some point, momentum will push us up to fill the gap that was left from the steep decline last week, right? This decline here. And let me show you the gaps that I'm talking about. We have a gap right here, a gap right here that needs to be filled. And I'm just going to shade that in with a little gray area because we don't need to, it's not that important right this moment. I'm going to clone this because there's a second gap that goes from here and actually is a little bit of a bigger gap because it goes down to just above 3,800 at 3,815. So we have these 2 gap downs right here. And remember, all gaps get filled. What does this look like to you? We have bottom, we have bottom, and we have bottom. What does that look like to you on the 15-minute time frame of the S&P 500? Let me know. I'll tell you in just a moment. Can you name it in the comments? Nevertheless, though, today can still be viewed as a good day for the bulls. Granted, cyclical sectors were weak, but money rotated within the stock market instead of out of the stock market altogether on growth concerns. In turn, the market once again showed resilience to selling activity despite a band of bad headlines that included a larger than expected 50 basis point rate hike by the Nords Bank, reports that Russia is close to taking over a key province, and weaker than expected preliminary June manufacturing and services PMI readings, not just for the US, but also for the Eurozone. The resilience in the face of that bad news was additive to the belief that the market has scope to forge a rebound from deeply oversold conditions into quarter end on rebalancing activity. Remember, contractions lead to expansions. Expansions lead to contractions, and contractions lead to expansions. And right now, we are in a contraction phase of that cycle, waiting for our next time to expand. This pattern right here is an inverse, upside down, head and shoulders pattern. And what I'm looking for here is this 3,800 level needs to get wiped out. Now, we move above 3,800 level, right? Put it right here. That brings us into filling this gap right here as the potential target. And the high on that target is 3,900. 3,900. On the SPY, I believe that would be about $390 ish. It's not a complete connection there, but it's really, really close. I can look at the SPY and show you this exact same thing. So this is our first target area, and it looks like we are in a contraction phase right now that will lead to expansion, and I believe that expansion could go fill in the gap. But just like 3,800 is a tough resistance line that sellers will step in and sell, 3,900 is also a line where sellers are going to step in and sell. And guess what other level? 4,200. 4,200. Sellers are going to step in and sell there too. It'll be a march, and it may take time. This unfolding right here, this little rally, right? First knocking out this gap that needs to be filled. Then maybe after this expansion of filling that gap, maybe we contract, right? And then after we contract, we expand again to fill in this gap. And then we contract a little bit. Maybe that's the summer rally and the pattern that we're going to get out of that summer rally. And this may take months to unfold. It may take all the way to September to unfold before we go back down and find the new all-time lows. Interesting, huh? Let's see here. Head and shoulders, you got it. Upside down head and shoulders. You both are correct. Great job. My calls will go crazy. Yes, they will. So just to get this point home, we had expansion right here that led to contraction, that led to expansion, contraction, expansion, contraction, expansion, contraction. Now, is our next expansion move up? That's honestly what it looks like the market is building to. And the quarterly rebalancing activity could be the catalyst that moves the market up to fill that gap. All right. So I just wanted to get this pointed out and make it clear. This is my theory for right now on where I think the market is going, where it's heading in the short and medium term. But my belief that in the fall, we're going to get to, unfortunately, I think, new lows. Unless something drastically changes in the economy, unless the Fed pivots. If the Fed were to pivot, that would be a huge catalyst, and it would literally be the ignition to light a ship that sent the market up fast, like face ripping off fast, right? All right. So we got that. That's looking good. Now, separately, I want to talk about Fed Chair Powell. He appeared before the House Financial Services Committee for his day 2 of his semi-annual monetary policy report to Congress. He was in the Senate yesterday. Now, the views expressed were those that were prominently a rehash of what he had said on Wednesday before the Senate Banking Committee. So, there was a muted reaction to his remarks. We can be thankful that he didn't throw a monkey wrench into the market today. That's a good thing. Now, a couple of individual stocks to talk about. Earnings is going the Facebook, Netflix earnings 2.0 for all companies. Yeah, earnings are going to get harder and harder and harder as we move along in this year. As we move through the year, each quarter earnings will get rougher and rougher and rougher. Earnings is going to be Facebook, Netflix earnings 2.0 for all companies. I got you. I got what you're saying. I do. And that brings in the 2019 theory, right? Where stocks can go down to the highs of 2019. It's not unthinkable for that to happen. All right, I want to talk about FedEx. FDX is the ticker symbol right quick. Let me get FDX. They reported earnings after the bell today. They missed on EPS and revenue, but their guidance wasn't that bad, all right? Last time I checked, they were up a bit in the after hours. Let me just adjust this chart here. All right. So yeah, they're up 2% in the after hours as it stands right now. So we pull up their earnings here. This is their fiscal year 22 Q4 earnings. And we have a reported EPS of $6.87 a share. It missed by a penny, not a whole lot. And on revenue of $24.4 billion, which was an 8% year-over-year gain. And that did miss by, well, they have it by 100 million here. I think it's closer to 160 million, what they missed by. However, the reason shares are up 2% is because better than expected guidance. Despite overhangs in terms of inflation and general cyclical concerns. FedEx also, this is another bonus to why the stock is up 2% in the after hours, and why I think FedEx is a good company to get behind and to have in your portfolio, is it also indicated its intention to repurchase $1.5 billion of their own stock over, not the next 12 months, but over the next 6 months. That's going to make that money work a lot harder to raise the appreciation of FedEx. Now, just to give you some context here, FedEx added $2.2 billion throughout the whole year of its fiscal year 22. So let's see what $2.2 billion did for FedEx over the past year. Well, number one, I need to get back to the daily view and not the 15-minute view. Okay. Yeah, all kinds of writing there when I was trading FedEx hard when it was peaking. Okay. looking at FedEx over the past 12 months, if we go back to June, June is down here. All right, so June is right here. So over the past 12 months, FedEx went from there to there. Now, it had a pretty big spike and then kind of slowly moved sideways and down over that year. It was crazy. But on the year, though, on the year, and let's just measure that. If we go from the highs here, from June 2020 to where we are right now, you wouldn't be in the hole. You'd be up 66.8%. And remember, FedEx also included a $2.2 billion share repurchase during that time. So over the next 6 months, FedEx is spending another billion. 6 months would take us out about here. About here. It would take us out to right about here 6 months from now. So in 6 months' time, do you think FedEx is still going to remain at this level right here? Or do you think over the next 6 months' time, FedEx is going to continue maybe this little, and it's not even a trend line, so it's not accurate. It's just for visualization to help you see. Maybe FedEx moves more like over the next 6 months with that added $1 billion+ in share buybacks. So we have that to watch as well. Okay, let's take that off. Let's get back here. Let's just clean this up just a little bit. Take a couple of these marks off. Okay, so FedEx. Earnings, not so great, but their guidance was good. All right, I want to talk about Coinbase real quick because they had a pretty good day. COIN coin, that is the ticker symbol for Coinbase. Now, during yesterday's live stream, we talked about the after hours news that Coinbase was going to sunset its Coinbase Pro app and website, and they were going to transition to bringing it over to the main Coinbase app and Coinbase.com, their main website. And yesterday, when we were looking at this, the stock was down a little bit in the after hours, and the news, it didn't move the stock. But today, it moved the stock 13.4%. That's pretty good. That's what I would expect, because remember, all of these crypto brokerages or crypto platforms, there's many different types and kinds and shapes and sizes. Some that are big like FTX, and some are small like BlockFi, and Coinbase is a dominant player, but they're all trying to attract as many users as possible during this crypto winter. And during this crypto winter, it is going to be good, like I said yesterday, for the consumer, for the user of these platforms, because we'll get the competition between all these platforms. Hopefully, that would be the goal, and that's what you would expect to see. And all these great and wonderful features will be popping up, and transaction fees could also be going down. Good for the consumer. What's that look like for the balance sheet for these companies? It probably doesn't look good, quite frankly. It probably doesn't look good. Not until this is like we're taking a pit stop, right? In a big Indy race or something. We're taking a pit stop, getting our tires changed, gas filled up, window wipe clean, whatever the case may be, right? This is the time where all of these crypto platforms are coming into the pit stop and they're adding new things on to attract as many users as possible. So that way, when we get through this crypto winter, they have a base of customers, just like if we look at Bitcoin, just like we have a base that needs to be built. And I think the base is going to be built right in this bottom red box. Let me hide the volume. I got to get rid of it, make it easier. This bottom red box, that's where I think the base is going to be built, which is $16,000 to $20,000 for Bitcoin. And as this base is being built to be the launching pad for the next bull cycle, then all of these crypto firms, platforms, are going to be beefing up their suspension and steering and whatever the case may be to make it better, make a better experience for the consumer for the next bull run. So I wouldn't be investing in any of these crypto companies yet, but once we get through the crypto winter, then I think it would be okay to pick a few and run with them. I also think now is a good time to consolidate. And the phrase that I'll use is to build your quantity. Right now, it's not about the quality that you're getting with Bitcoin, because there's a lot of volatility that comes with it. But what you should be doing is building the quantity, the number that you have, and building that out bigger and bigger and bigger. That's what I'm doing. That's what I believe is the right course of action. So when we get through this crypto winter and we get to the other side, we'll be ready to go. And this works with stocks too, right? If we go back to, either picking indices or picking individual stocks, you want to right now make sure that you are adding quantity to a select number of stocks that you believe in. Okay? If there is a particular company that you really like, you want to invest in, now is the time, while the cost continues to go down, to build the quantity, the amount of stocks that you hold in that company. Grow it out. Dollar cost average down. I know a lot of people, just use that word, and I think it's kind of lost its meaning in some sense, but dollar cost averaging for the long-term investor, it's not about timing the bottom. It's about building the quantity of stocks you have in the companies that you love in times of a down market. So when the next bull cycle begins, you've got a boatload on companies that will do great. So just a simple message. I'm sure all of you completely understand that right now. That's NVIDIA for me. Absolutely. It's NVIDIA for me too. I definitely think NVIDIA is going to be a major player as we continue moving forward and as we get to the next phase of whatever this internet is going to be, right? And it's pretty cool. Oh, I forgot to mention, I think it was Tuesday, I think it was Facebook, Microsoft, and NVIDIA. They all came together to create some sort of a committee or organization for metaverse standards. So when these companies are building out the next version of the internet, they're working within some framework together, so things will just smoothly work from one place to another. And yeah, NVIDIA will definitely be a major winner in this next bull cycle for sure. I did want to touch on WeWork real quick. Ticker symbol is WE. WeWork it's more of a speculative a company, more of a growth company in a way. But they were up 15.6% today. They've got themselves wild swings, just completely outrageous swings. And making sure the stock loads here. I want to find out that day. It looks like October 21 of 2020 is when they came on the market. So they have not been a public company long. So this is more of a speculative stock, which is not one to buy right now. You don't want to buy speculation right now because it's too risky. And we want to limit our risk right now. But WeWork being up over 15% today, this morning, they got an upgrade to outperform by Credit Suisse. And they cited that the company's position to take advantage of the structural demand for the flexible office is great. And something else to note, it may have played out a little bit today for why it was up over 15%. But with the last data that I have access to, WeWork had a decent amount of short interest at about 30% of their total float. So keep an eye on that. That could work out in a weird way, and it could get people to jump on that. I know it had a big move today, so but it has big moves all the time, quite frankly. So just keep that in the back of your mind. Okay, let's talk a little bit about the economic data that we got today. In the after hours, okay, the Fed, it released the results of its annual bank stress test. Now, the Fed releases the results of its annual bank stress test, which show that banks continue to have strong capital levels. So everything in this report was pretty positive for the most part, allowing them to continue lending to households and businesses during a severe recession. Catch that? Severe recession. Severe recession. That is going to bring the market down if those two words play out together. And then if we hop over to, I believe it's page 16 here. It's a real long report. All banks tested remain above their minimal capital requirements, despite total projected losses of $612 billion. Under stress, the aggregate common equity capital ratio, which provides a cushion against losses, is projected to be a decline by 2.7 percentage points to a minimum of 9.7%, which is the last in bar graph, the last bar here on the bar graph, all the way to the right. That's that number right there, 9.7%, which is still more than double the minimum requirement. So, again, for the bank's stress test, for the Fed's bank stress test, they passed. Okay, so the Fed thinks that the banks are in good condition right now and have enough capital for something went wrong. So that's a positive. And it could be an uplifting move for the market tomorrow with this news. Then we had our initial claims for the week ending June 18th. It decreased by 2,000 to a total of 229,000. The consensus was 230,000, so not that far off. While continuing claims for the week ending June 11th, it increased by 5,000 to 1.315 million. So the key takeaway is that it's another reminder that the improvement in initial jobless claims has completely stalled. Nonetheless, they remain at low enough levels to support expectations for another solid increase in non-farm payrolls in June. Because remember, this report, it covers the week in which the survey for the June employment report was conducted. So the numbers that we got for this week are going to parallel with what we get in the June final numbers for the month. Now, looking ahead, market participants will receive the May new home sales report and the final reading for the June University of Michigan Index on Consumer Sentiment. Both of those reports come out at 10 a.m. Eastern Time for the market to digest. Now, I can't imagine that the new home sales are going to be amazing. I don't see that happening. All right, I want to run quick. I'm going to look at the SPY here, SPY, and we're going to see the same pattern here as we did for the S&P 500. And here's the key level. So we got that, and this, and it's real interesting that it's a gap down and then a gap up to make that. So, you know, these two gaps right here are gonna need to get filled back in at some point. But I don't think, at least I'm not predicting. Predicting is a bad word. My investment thesis does not think that those will get filled in relatively soon or on a short-term basis. I do think in the fall, that's when we could be coming back down to new lows. But short-term, I think we're in a pretty bullish structure-ish, because, you know, we are ultimately in a downtrend overall. So we do have to be careful. Volatility is still high. And with volatility being high, that means there can be some pretty crazy pretty strange moves in the market. I can't believe what I just said. You can have the market, you know, whipsaw up quick, run maybe 2%, and then boom, fall 1.5%. So the volatility can be tough right now. So on the SPY, we got a key level right here at 380. Okay, 380 is key here, and then we get up to the first gap, which, let's just put that rectangle in. That first gap covers basically this space right here. 380 is the bottom of it. The top of it is about 390. Okay, and then if we go with that next gap that needs to be filled, it runs right here. I went too far. It runs right here. The bottom is about 395. The top is 400. So those are the key levels there for the SPY. If we look at the Qs, QQQ, and then we'll look at the Nasdaq after this, you see a very similar pattern again. And what do we have? We have expansion coming down. I chose the wrong tool. That's not what I wanted. We've got expansion. Here we go. We've got expansion coming down. Then we have contraction, expansion, contraction. Okay. You get my point. There we go. And then we got our expansion. And now we're contracting, waiting for our next expansion. Now, to get the expansion that we need, we've got a couple of gaps to fill. Oh, I didn't want to do that. My apologies. We've got a couple of gaps that we need to fill in here. The first gap is it halfway got filled. Okay. All right. So let's raise this up. This is a smaller gap because it halfway got filled right there. Okay. So and we're touching that. Okay. We're at the bottom of that right now coming into it. It's about 285 on the Q. 285. That's what you got to break above to start filling in this gap. Nice and slow and steady. That would be the best way here. So don't get set up and looking for longs just yet. Stick with being patient and waiting for the right play to play out. And then here's our next gap right here that will need to get filled. And again, well, resistance after we get past this 285 on the Q, we've got looks like about 288, 290. And then after that, it's about 295 up to 300. So that's that for the Qs there in their space. And if we look at the Nasdaq here, again, similar pattern. We got the inverse head and shoulders, but something interesting about the Nasdaq is in a falling wedge pattern. Okay, it is in a falling wedge pattern. And you can get other patterns within patterns. That is totally possible. And again, we've got this kind of inverse head and shoulders right here. Shoulder's a little wobbly, but we still got it nonetheless. But that just means the gap that we had here, which was pretty big, has been partially filled. If we go all the way down, I mean, really, the right shoulder there is filling a part of that gap. So what do we have left then? Well, it's at 11,700. 11,700 is the resistance area. And then we'd go up to 11,830, 11,830. And then we get to our next area, which is here. And quite frankly, what it could do is it could push us right up against the top of the resistance line for the falling wedge. And then we get caught there, and then that could push us back down. Just as a possibility and example there. So just be careful when you're out trading. The market can definitely go in different directions than we expected. Okay, so the China-Taiwan thing scares me. It does me too, but it doesn't keep me up at night. It's going to happen at some point. At some point, China will make a move on Taiwan. It's just it's a given. It will happen at some point. And are we prepared to face that? Are we prepared to handle that in the future? That's the question. So as long as you're prepared and you have, you've got emergency funds set up to cover your family for you, if something arises, that's fine. The stock market, it'll be here. It may fall, which then may give us some good buying opportunities. Just look at coming out of World War II. The market, the economies for the U.S. did great. Not so much for some other countries, but the U.S. was able to come back from that. I don't know if it's going to be a World War III if China invades Taiwan, but it is a scenario to think about. Whenever I'm doing some sort of a project or anything, whatever it may be, I'm always thinking about all the different options, all the different possibilities that could occur. So we do that with trading, we do that with investing, we do that with everything in our lives. We just make sure we're prepared, and that's all I'm getting at. Maybe let's go to the what's Dave, what are you saying here? Maybe the banks and feds learned from Lehman Brothers and the financial crisis. Maybe, but there's something different this time. And I know it may be cliche to say, oh, there's something different about this time versus last time, whatever. 2008, okay? We had a problem with bad loans, all right? Bad loans. Bad loans created foreclosures. Foreclosures created a flood of housing inventory on the market. That's the complete opposite of where we stand right now. Where we stand right now in the housing market is we don't have enough homes for people to buy. And then to cap that off, we don't have enough homes. We also have homes that are way too inflated in price, and affordability issues start to come into play for many people. And then they can't buy those homes because of the inflated price. So that's a great big difference that I see between the 08 financial crisis, housing market crisis, and today. Today, I think it may end up being more of a liquidity crisis because of inflation. Something to think about, I guess. But whether they learned their lesson or not from last time, I have no idea. Hopefully, I mean, they've got smart people working for them. The talking heads that are appointed by the government, maybe not as much, but there are smart people working there, okay? A lot smarter than I am, that's for sure. And they game out many different situations. That's why they do a stress test for the banks. They want to make sure that those banks aren't going to fail on tough conditions, like a, quote, severe recession. I can't believe I can believe they have to do the scenario of a severe recession, but that just caught my eye and I had to mention it because are they foreshadowing something, slowly telling us information bit by bit that, well, the economy is not doing as great as we are saying it is, catch our drift, hint, hint, hint. It could be. Let's see here. Let's see. Put that up. All right. Do you consider the candle wick as filling gaps if they extend up or down into the gap area, but the candle body does not fill? Okay. Great question. That is a great question to understand. So let's go back to the S&P 500, SPX. And we're going to go in here a little tighter. I'm going to still leave it here on the 15-minute time frame. I just want to pass 3 days, this head and shoulder, reverse head and shoulder here. Okay, when we get to key levels of support or resistance, what you want to see is not the wick. You want to see the body of the candle. If it is support, you want to see the body of the candle. If it's gone below that support during, intraday while the market is open, you want to see by the time the market closes, you want that candle to be right there back on top of that support. That's what you want to see. For resistance, the same thing. Maybe you break above it, but then sellers step in to bring it back down. You want to be right up against that resistance. And then for a follow through on that resistance, you want to break above that resistance, and then you want to close with the candle, not the wick. You want to close with the candle above that resistance line. So where the candles close are the most important parts to look at. The wicks, they can help you in possibly determining whether, you see a little reversal pattern. If the wick looks like a hammer, if the wick, let me get my, all right. So if you have a big old wick, right, like this, but the candle itself is just, filling down here in this area, that's a hammer candle, and it could sign a reversal, right? And same thing with the opposite direction. If you have the wick, but the candle part itself is just up here in this one section, it's a hammer candle, it's reversing in the opposite direction. So where the candles close, like for example, that candle may have closed right on this line, that's good. That's good. You want candles to close on your support lines. If you're running into resistance lines, you want them to close on that resistance line. And we'll use this one for an example. Maybe it closed on the resistance line right here at the top, using this top line right here. But then the next day, whatever the wick might look like, you want the candle body itself, like this, to close above that resistance. And that shows that maybe this old resistance is now turning into support. And that happens all the time. So it's very important for where the candle closes. I hope that made sense to help you understand those candles a little bit better. I'm just keeping it super simple. That's the first thing to master and look for. Where do candles close? Now, let me go in a little closer on the past 3 days over the past 15-minute chart here. Remember at the beginning of this video, I was looking at, okay, where did the top of the candle wick reach? And for today, that top was 38.02. So that's how high it got today. Yesterday, it got to 38.01. So slightly below it. Again, I'm looking at the wick on this one. And then the day before, the top would have been right here at 37.79. That's the top of the wick, nearly the top of the candle for that one. Those are important breakthroughs, right? They can happen intraday, like yesterday. This was intraday. Today, it happened on the closing 15-minute candle. So there's the second thing to watch for, all right? This would be saying that, we're getting higher highs right here on the past 3 days, which is a good sign. But it doesn't mean that we're not immune to any pullbacks. And the volatility over the past 3 days has been crazy. I mean, yesterday, we started out super low and then had to build throughout the rest of the day. And then today we had that big drop off to the bottom and then back up to the top. So 2 things to watch there: where the candle closes, and then how that matches up to where the previous candles are, the previous candle highs, etc. And then how the wicks can also be used as well. And then there's a whole lot of different digging that you can do on charting patterns and wicks and how they different patterns on different wicks and what they mean. There is literally an abundance amount of knowledge out there to use. Okay. Yeah, I mean, in terms of investing in NVIDIA, yeah, NVIDIA, it's good. Thanks for the candle diagrams. All right, that's awesome. Glad that helps. Whatever I can do to help, that's what I'm here for. All right. Well, I've gotten to the end of my mission today. If you have any questions, now would be a good time to plug them in, just like the ones we've been getting. Excellent questions. I love it, guys. I appreciate you and your questions. Just let me say this. Do me a favor while you're getting your question ready or getting ready to sign off and go about your day. Do me a favor and click that like button. It really helps a small channel like this. And if it's your first time watching, click that subscribe button. That also helps a small channel like this. And if you like the perspective, if you want more to help you along your investor journey, then click the first link in the description of this video and join us in beating this crazy market. There's a ton of information that we share, and I think it is very valuable to help you along your investor journey. And that's all I'm here for. So I thank you for that. And I am appreciative again for all of you watching. Looks like the comments are done. So we'll wrap it up here for today then. If you guys are feel good. Okay. How do consumer discretionary, let's pull this up here. How do consumer discretionary stocks do in times of a recession? I know they're doing okay right now, but in a recession, do they get hit the hardest? The simple answer is yes. Consumer discretionary is discretionary income. During a recession, people don't have discretionary income like they do when we're on top of the market and everyone is gainfully employed. The market's at its tops or rallying every day. It's going up. People have more money. Home values have risen. People have more money that they can spend. So recessions are tough for consumer discretionary stocks. Yes. And it's all based on the simple principle of less money to spend outside of your needs. Your wants will wait until the recession is over and you have that discretionary money to spend. I keep it simple, just like that when it comes to it. How do you like my solar calls last week? I'm sorry, I read that wrong. How did you like my solar calls last week? Oh, let me pop in TAN, A-N. That's the Invesco Solar ETF. And we were talking about it. Let's go back to the daily view here. And if we go back, you can see beautiful run, fall back. And then if you look at this right here, there was this gap down right here. So over the past 1, 2, 3, 4 sessions, 5 sessions, there's another one in there. It's been marching higher to fill in said gap right here. So that looks beautiful. Absolutely beautiful. Should have clicked that first. Yeah, those solar calls, that was a good one. Absolutely. It went right up, marched up, filled in those gaps. So now the question is, Where are they going next? Where could solar be going next? I think any alternative energy, solar especially, I think it's got a great future ahead. Going into a recession, it's going to run into some problems because adding solar for residential especially is a consumer discretionary type of spending. So we may see some issues there. However, if people can get connected with the rebates that the government has for adding solar, and they can see the benefits of the cost savings, then maybe as we're coming out of the recession, they'll be looking for ways to permanently save money. And I think that would be a great time for solar to kick off because it's a good way to save some money on your utility bill. So it looks good. Would you consider Unity stock? They would also be a player in the metaverse. I do. I like them. I wouldn't buy them right now. And let's just, all right. Just want to clean this up just a little bit. All right, so solar, just real quick, it could continue to march higher, at least to get to this candle. And let's get this out one more time. To get to this candle right here. And once it knocks that candle out, I think the 200-day moving average, it's obviously going to start flattening out as this continues to march upward. I think you get to that 200-day moving average up there, and that's going to be a real area of resistance to test. Because if we go back, you can see the last time it got there, it broke above it a little bit, but it was a hard no. Right here was a super hard no at that 200-day moving average. So that's the risk that it's going into right now, at least this ETF, TAN, T-A-N, of moving higher. So it's still got a little room to go. And then it is, I think, looking to maybe head back and pull back a little bit. But right now, RSI is at a 53, so it's kind of right there in the middle. Money flow is also a 53, so it's right there in the middle. Not too bad. So it's got a little more room to go. At 200-day, that's what I'll be watching for as a possible. Well, we got a problem there, Captain. Okay, let's do this one right here, Unity. Get the cursor on the right place. Ticker symbol is U. All right, we're looking at the daily view here for Unity. And if we go back and just look at this, a little history of how the stock has reacted since going public. When was this first day here? It would be September 18th of 2020. 2020 was a big year for SPACs and IPOs and DPOs. Good fanfare, of course. 2020, big year for a run-up. 2021, again, ran up to the high here in November, but then it's been selling off. I don't know that it's reached its bottom yet. I wouldn't say so. It had a nice 13.5% run today in the market and 0.5% pullback in the after hours. So what it's looking like here is this is an area that looks like it's building up some sort of resistance right here, which if we just kind of draw a line right over is right at the bottom, the wick of this candle right before the gap was made. Now, the gap is filled in. right? The gap's been filled in. These two highs that just hit on the 23rd and also on the 8th, those are your resistance areas that you want to see slowly moving above. So if we go back to the 8th when it was there, the high 47.12, the high now 44.64. So that's a lower high. That's not what you want to see. But again, there could be a summer rally that we have for many stocks. Maybe it's a very broad-based summer rally. It's a possibility. As a matter of fact, I think it's a pretty high probability that we at least move sideways and slightly up over the summer. When we get to the fall, that's when my investment thesis the market breaks down at that point. We get a lot of FUD leading into the midterm elections in November, and October is, I believe, is going to be a very hard month. We may see our new lows hit at that point in October, and then maybe we can finally form a bottom and start to dig ourselves out. But the main thing to remember is it doesn't matter whether you are buying in now or you're buying in October. This is a bear market that we're in, okay? Whenever you decide to buy in, no one's going to time it perfectly. I'm sure there'll probably be one person out there who does get to time it perfectly, just like, someone always wins the lottery. But just buying in now with these discounts, hold off on the speculative ones, some of the technology ones, maybe go more on the defensive side, or maybe just park it someplace, and just wait and be patient. Patience is very important right now because we don't know when the bottom's coming. We don't know when the bottom is finally going to get here, and we don't know when the next bull cycle will begin. It may not begin until after we're out of the recession. That's a possibility. So just make sure to be patient. Don't jump on any rally that you might see because it could easily just fall right back down. Volatility, I've said it like 5 times during this live stream, is high. Be patient. Buy when you feel comfortable. And then hold on. The next bull cycle, you are going to be rewarded. It's really that simple. Work on quality of stock, and then or quality of company, and then quantity of stock in that company, right? That's the 2 things that I want to set as a goal for all of us in the investing community. Find the highest quality company out there, and then start building up the quantity of shares of that company. That's a goal for all of us. Okay, thank you again so very much for your questions. I'll go ahead and wrap the stream up now. I greatly appreciate each and every one of you for joining me. I do. I really, really do. Answering your questions is the best part of this live stream and the whole reason I do it. So if you could, just real quick, I said it once before, I'll say it again right now as we close out the live stream. If you found something interesting, if you learned something new, if you like this perspective, click the like button, subscribe, share the video. Those 3 things are very helpful for a small channel like this. And if you really do like this and you want more of this content to help you along your investor journey, then just click the first link in the description of this video and join us. I'd love to see you there. Join us in beating this crazy market. All right, ladies and gentlemen, thank you so very much for joining me. I will be back here tomorrow after the market has closed, and we'll do our weekly wrap up of the market and see what it gives us. Okay, thank you guys so very much for watching, and I'll see you in the next video. Take care.